Hi, well, it's Mark Fielding Pritchard of ME Fielding back again here. Now we are up to part number 4 of our implementation issues. As I said at the very start of part 1, I think there's going to be about 10 of these in total, because we tried to keep them kind of nice and snappy and short for you. So, remembering that what we're doing, we're not looking at implementation from the point of let's just go and have another go back through the IPSAS standards, because everyone and their dog has made a YouTube video or written some kind of book on interpretation of IFRS. What this course is really aimed at, and I've said this before, is it's really aimed at people who are actually undertaking implementations in practice. The assumption is that you know your standards. If you don't know your standards, there's a million and one guys out there in universities who'll teach you about them. What this course is really about is that the other aspects of that, and in particular with those other aspects, looking at discovering where the system is now. Remember, IPSAS implementation is going from A to B, B being an IPSAS compliance system. Right, we all know what that should look like, and your Oracle or your SAP system will produce it for you. The difficulty is finding people who can tell you where you are now and understand how the whole system hangs together. Secondly, once you have an understanding of where you are now, it's involving the IT guys and getting your ERP system, your computer system, up to scratch to get you from A to point B. In part number 1, therefore, we looked at the advantages of adopting these things, why we would bother to actually do it at all, because remembering that you're going to need to persuade people to give you their time, to give you their effort, and to give you their money, and so on. In the second part, we moved on and looked at some other kind of issues based around IPSAS, and then in the third part, we looked at the barriers, so the things which are going to cause you difficulty. So those are our 3 courses so far, with a fantastic description there of part number 2. What we're going to be looking on now, therefore, is some of the kind of discussions you're going to be having. Please, therefore, remember to download the book. So please download the book that goes with the course. Okay? What we're going to move on to, therefore, now, as you can see from the slide while I'm yakking away here, is the framework. And what we're particularly interested in this session, therefore, is looking at what are the differences between the public sector and the private sector. Because it's probable that guys in the departments and the governments that you're looking at will have some understanding of what IFRS is. They may even have companies in their country which are using IFRS because they're looking for finance abroad or whatever. We need to be completely aware of what the differences are between public organizations and private organizations, and we need to be clear on what those things are so that we can develop suitable accounting policies. But we need to look at differences in things like the purchasing cycle, which actually shouldn't be so different, but things like the purchasing cycle, but particularly what the kind of things are that we're purchasing, because you can't just take a manufacturing chart of accounts and chuck it into a government. It won't work because it doesn't work like that. So we've got this idea of the differences. What's the differences between the things that you're procuring? What's the differences in the assets? To some degree, what the differences in your revenue are. Again, I don't really find massive differences in revenue. But again, we talked about the framework as well. There's a difference in philosophy. There's a difference in philosophy in what a government is all about. An ordinary company, we talk about Tesco's and PricewaterhouseCoopers, are all about cash generation, about profit generation, about dividends, and I guess PricewaterhouseCoopers don't pay dividends because they're a partnership, but they pay profit shares in cash out to their individual partners. So it's all about this idea. It tends, therefore, to be everything's driven by profit, tends to be more short term, and your strategy, therefore, is aimed at identifying markets, moving into those markets, and then becoming the dominant force in that market and generating profits from it. Governments have a much more esoteric role, and if you want to go do a really long discussion with some economists, go and talk about what is the role of government. We all have different ideas on what that role of government is, but at this stage all you need to do is to accept and understand that government is different from a company. And therefore we're going to run through these things now and the things that we have in here just to highlight what those differences are and how they're going to affect you during implementation. So now then you need to be looking at the slide, which is up there. Finally he gets around to the slide after 5 minutes. So the first one says historic or current. What does this mean? It means the nature of reporting. There's a big argument in accounting, and this isn't just limited to government accounting, to public accounting. Should we be showing historic information or should we be showing current information? So in other words, when you purchase an asset, should you be showing the historic cost? Or should you be showing, therefore, in your balance sheet, what is the current cost? Now, at the point of purchase, those two things will be the same. The current cost and historic cost will be the same. If we go 5 years down the line, do we keep historic cost in our balance sheet, or do we introduce a market valuation? If you look at IFRS is moving much towards market valuation. So we have revaluations of assets, but bearing in mind that some countries do not permit in law for you to revalue assets. So you need to make sure you know that. But under IFRS, we have revaluations. I come from the capital of Scotland, which is called Edinburgh, and in the middle of Edinburgh, we have a big shop, which is called Jenner's. Jenner's shop was purchased for 100 guineas, which is 110 pounds, in something like 1880, and it still sits in the balance sheet at 100 pounds. Now, every single year, Jenner's accounts get qualified because they refuse to revalue that asset. Maybe they've even done it. It's a long time since I lived in Edinburgh. But that's an example of the differences. Now think as well about how long government assets last for, roads and so on. They last much longer. So we have this thing, therefore, should we be showing things in our accounts at their current value, or should we be showing them in their historic value? For the purposes of this, for implementation, you will almost certainly find that the government shows all of its assets at historic value. I think every country I've ever worked in has a government that shows its assets at historic value. If they show their assets at the historic value, there is a significant chance that those assets are significantly undervalued. Moving to IFRS, or in our case IPSAS, therefore, is going to take a change in practice, a change in policy, and a change in mentality as people get into this idea of putting the value of the current value of their assets into the balance sheet. Now we're talking about fixed assets because they're kind of easy to understand, but you've got financial liabilities as well. Remembering if you've got securities which are held for trading, then profits and losses will be going through your income statement and they'll be shown in their balance sheet at their market values. So we've got this idea again that we purchase some securities and the government will own securities. You know, the Russian government owns shares in Lukoil and so on, and these things are shown at their market values. So historic versus current. In terms of implementation, you are going in significant areas of your accounts from a historic basis to a current basis. That's number one. Number two, the role of the budget. The budget, certainly as a science, budgeting is well known, well respected and used by everybody. So if we look at Tesco's, we look at PricewaterhouseCoopers, they will absolutely have budgets and they will put limits on spending to their budgets, and people will be expected to stick to budgets. I remember my day as a manager in PricewaterhouseCoopers, making sure we didn't go over budget for our tax clients. Within the realms of those budgets, there is likely to be some kind of flexibility. The budget is not written in stone. If you also, as a manager at Coopers & Lybrand, if you have excess budget in one particular area and shortage of budget in another, there are ways in which you can change those things. So you have to be careful. You can't overcharge clients and so on. But there's a degree of flexibility. The budget, therefore, is a management tool. As far as managing the business is concerned, though, the key documents really are the management accounts that show that, you know, we've got some extra revenue, we've got some less revenue, how does that affect what we do? There will be strategic documents which will fit in there. So you've got this idea that the budget is one of the management tools, and it's one of a suite of management tools, and there's probably ways in which it can be amended and changed fairly simply and in a straightforward fashion as circumstances change. Compare that to a government. Your budget is your statement of how the government will fulfill its mandate from the people. It's almost certain, therefore, that your budget is set in law. Budget revisions will happen at certain specific times of the year. Usually in certain, like Soviet countries, it will be like the 30th of June and the 30th of September. So we get this idea, therefore, that the budget is actually the main document and it's the key document. And changing it is very, very difficult and very, very public. If you are fortunate enough to have surplus revenue, it's probably easier to invest the surplus revenue and then put that into next year's budget, because that will be easier than changing what you have in the current year. I think it says somewhere in the notes, I actually should have the notes to do when I teach. So remember the book, download the book, please, please, please. It says in the book somewhere that when you work in countries where discretionary spending is very small, so in other words, they get told what to spend when they get told what to spend it on, you can actually prepare your 2014 accounts on the 1st of January 2014 to something like a 1% degree of accuracy, because it's so close. Right, that is critical for your implementation, and we've talked about this already, and we're going to keep talking about it all the way through. Understanding what your budget is, where it comes from, how it fits into the accounting system, because it will be linked into your procurement, which actually will in PricewaterhouseCoopers and Tesco's as well. But that budget is the key document, and you must remember that you cannot say, oh well, it needs to change to accommodate the accounting, because the chances are that everyone around you is going to go, no, the budget doesn't get changed. It's the accounting that will have to be the flexible part. Now, it's possible that you may have to change these things, and you may have some leeway, but you'll probably have to keep it to a minimum. So, differences between public and private enterprises. Public enterprises, the budget is much, much more important, much more difficult to change, much less flexible, and much more public than it will be in a commercial enterprise. Okay, number 3 on our list, the nature of assets. The nature of assets is completely different. If you have a company, and again, it'll depend on the nature of the company, but if you have a company like PricewaterhouseCoopers, which is always a bad example because it's not really a company, it's a partnership, but if you have a business like PricewaterhouseCoopers, the assets are virtually zero. They may own a certain number of their buildings, they may own some of their motor cars, and they've obviously got a huge stock of computers and tables and chairs, but overall, really, the number of assets that they have is very low, and the life of those assets, taking it as a business in a whole, is very, very low. You can now compare that in Western Europe, I guess, to much more asset-dominated businesses. I mean, the obvious one that we always use in a lecture room is an electricity company. So an electricity company, therefore, has its permanent assets that never change. A government is kind of like an electricity company, only even more. It owns all of these buildings, which are never going anywhere. If it's a country where the government dominates the economy, and in many countries it's still 90% of the economy, then you have electricity companies in them. In addition to that, you have the kind of assets which are what we call infrastructure assets. So you have your water pipes under the ground, you have your roads, nowadays of course you have your telecommunication systems, and so on. The difference is that in a private enterprise, even an electricity company, you have an asset, and the purpose of that asset is to generate some cash. PricewaterhouseCoopers, you kind of have to twist that a little bit. You have a guy sitting at a desk, his job is to generate some cash, but the reality is that the whole process is based around cash generation. When you come to governments, we have this idea that our assets are much more visible, they're much more long-term, and they may not be quite so directly involved. The road is not only there to make a profit. The road is there to support the citizens and so on. The nature of assets that you have in a public enterprise is likely, therefore, to be much more important in terms of your balance sheet, and it's likely to be a much broader range of assets that you have as well. Your chart of accounts and the accounts that you produce will need to reflect that. And the fact also that your citizens want to know what you're using them for. Tesco's and PricewaterhouseCoopers, it's obvious. Not so obvious in a government. Why do we need these things? Surplus assets. Follows on from that, cash generation. So point number 4 on our slide is cash generation. And this is this whole idea, once again, that PricewaterhouseCoopers, Tesco's, my favorite 2 examples this morning that I'm doing this. Everything is based towards cash generation. And in governments, it's not. If you put up a nice beautiful statue of Lenin or a former king or some guy who won a battle 500 years ago, it doesn't generate any form of cash. Therefore, in that sense, cash generation is only really applicable. Cash generation is only applicable. This idea of cash generation is applicable to private companies, to the Tesco's of this world, and the public. The aim of the asset may be something completely different. You often find in countries such as Scotland that they run buses into villages. Now those buses are loss making, but they have to be run because we have a social obligation to give old people and people who can't afford cars the chance to come into the town and do their shopping. So we're budgeting that it's going to make a loss. And similarly, we have certain assets which may be there to provide a service. The object of the exercise is not to make money from them, but it's there to provide some form of a service. The police would argue that cameras that monitor people's speed are there for a social purpose. Okay? Right, that therefore is the start of this. Now what we're going to do is move on and look at more differences between public and private enterprises. So on slide number 1, we talked therefore about differences between public and private enterprises, and we talked about this idea of the fact that private enterprises are there to make cash, be it for their partners or be it for their shareholders. Governments have this broader social responsibility. So I guess you could almost say that the number of stakeholders is larger. If there are any of you out there who are watching this who've still got as far as part 4 and you're studying for ACCA or ICAW, you should learn these as well, because these have been examined before. What used to be the good old paper 8, what's that, I think P5 or something, F5. Right, I forget my ACCA. Right, differences between public and private enterprises. Public enterprises, i.e. the government, has a duty. And again, you know, 2 economists will argue this to the nth degree. But basically, I hope you agree that your government has a duty to protect the heritage of the nation. Private enterprises do not have that duty. Now, what we're seeing with environmental accounting and what we're seeing with social policies and so on is that companies are moving more to that. If you want to be cynical, you can say, well, they now Tesco sell organic food because it's more profitable than normal food, not because they care who has a heart attack or not. But that's a very, very harsh view. It's probable that the reality for Tesco's or someone is somewhere in between. They see a marketing opportunity, but they are actually, you know, the people making these decisions are not bad people. So there's some kind of split there. Right, organic food does not talk about the heritage of the company, heritage of the country. So therefore we have this idea that the government needs to protect the heritage. So therefore we have the idea, certainly in Britain, you know, you have listed buildings which you're not allowed to demolish. City where I lived, Edinburgh, I wanted to get new windows put in my apartment, in my flat, and I had to go and get a letter from the council to say that the new windows were suitable for an area because my flat was built in the 19th century, back when I lived in Edinburgh. And damn cold it was as well until I got those windows put in. So we get this idea, therefore, that the government is not making decisions based on profits and cash flows. It's making decisions based on the good of the country, and that good of the country is being reflected by the fact that we are celebrating certain types of successes that the country had. Certainly if it's Britain, then there'll be successes in war that we historically had. So the idea of heritage. Right, the next one down becomes very important for you. Longevity, or longevity. Longevity, I think the word is. I must check that. It's Google Translate to teach me how to pronounce English. Longevity, let's call it that. Right, longevity is this idea, there's 2 things here. Longevity, the first one, is that the assets tend to have a longer life. If you build an airport, the assumption is that that airport is going to be around for another 30 or 40 years. Maybe not in the state that it is when it's first built. You build extra runways, you build extra buildings, you build passenger terminals, blah, 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 whatever it takes. But in its essence, the asset will be around a lot longer. So therefore, we have this idea of the long life of assets. Now you can see the negative impacts of this, and you have to be really careful with it, particularly when you're doing project appraisal, because the longer the life of a project, the greater the chances are that the net present value becomes positive. So again, if you're doing ACCA or ICAW, watch for this. We saw this in Britain with the Channel Tunnel. they produced all of these things. They made projections for the Channel Tunnel, and the projections were made over something like 70 years. Of course, it came up with a massive positive net present value. People piled into the shares, and so certain people at that stage managed to make a good profit. But it became pretty clear after 9 months or a year that the thing was going to be loss-making, and we were never ever going to be able to turn that loss round. And it was simply because when they did the net present value calculations, they used an incredibly long period of time. So we get this idea, therefore, of the assets themselves, because we said longevity has two prongs or two sides to it. So the assets themselves are likely to have a much longer life. The second thing that goes with it is that there is a basic assumption that the country will be around for a long time as well. You'll see when you look at items in the conceptual framework, things like going concern. There is a basic assumption that if you have a country, so let's assume you have Great Britain, that country will have a government forever. Whether it is a moderately left-wing or a moderately right-wing government, or whether something revolutionary happens and we get communists or fascists or the military or pacifists or whatever, we make no political decisions, but there is still an underlying assumption that the government of Britain will continue in some form. That brings you into questions on life of assets. It brings you into questions because if you make a decision to start to build an asset and then you get a new government come in, then they can change it. God knows how many times have we started to build new aircraft carriers and they've been put on ice and then projects have been started again in Britain. So we get this idea, therefore, of going concern. So in terms of your accounting principles, is there ever a situation when going concern doesn't apply? There will be if it's a small department within a government. But for the national standards, going concern in principle always must apply. Just to give you an example there, this is a big question for the United States of America at the moment. Because if the United States of America was a company, its accounts would be qualified on the going concern basis. Because America is hopelessly bankrupt. And so therefore at that point, what time do we kick in? Possibly another reason why America refuses to adopt IPSAS. Okay, regulatory. Right, regulatory is different because the government has a regulatory role. It is unlikely that a private enterprise has a similar regulatory role. Now, it may do. ICAW, ICAS, for example, the Institute of Chartered Accountants up in Scotland and then down there in London, they regulate their members. So they have a regulatory role, and certain other bodies do. But those regulatory bodies, like Institutes of Chartered Accountants, so like the Insurance Ombudsman and so on, tend to be separate organisations. Tesco's, PricewaterhouseCoopers, have virtually no limit over the laws and rules under which they operate. They can hire lobbyists, they can certainly all be members of Institute of Chartered Accountants if it's PwC, but in principle they're operating under the rules. Right, therefore there is this kind of moral thing. There's the rule, so let's get as close to the rule as we can, and morally we're justified in doing everything we can as long as we obey the rules. That's not the same for government. Government is often making decisions because it is acting in a regulatory fashion. So therefore, when we look at our accounts and we present information, we need to make sure that the people who are reading the accounts understand exactly what they're reading. And there's also, of course, the fact that the government has the right to change regulations. So it can change regulations, it can make exceptions, and so on and so forth. So we get this idea that there is a regulatory difference. Again, if we look at a second spin on that, with regulatory difference, we can say, therefore, that the government is probably subject to more rules and regulations than our private enterprises. Because this idea of stewardship, so therefore the idea of watching what they're doing will have grown up over time. That is very true even in countries where you wouldn't imagine. You watch TV, this country appears to do exactly what it wants to do, but they still have a rule structure within their own organizations and their own departments. So regulatory, the idea that a private enterprise is quite straightforward. Here are the rules and regulations, we operate in this market and we follow them. With the government we have two strings. One is that they are regulators themselves, much more often. We need to take that into account presenting information. Secondly, the government itself will be subject to more rules and regulations. So we need to make sure in terms of implementation that we know what they are. Number 4, ownership rights. Ownership rights, usually, once again, it kind of follows on from regulatory, because ownership rights arise under a law. So your private enterprises, therefore, are going to have an opportunity, your private enterprises, therefore, will have ownership rights under the law as it exists, and they will purchase assets which they own, or they will lease assets which they technically don't own, but which they have the right to use, and those, again, should be relatively straightforward. Ownership rights, again, for the government are much more complicated, hand in hand with regulatory. Firstly, they will have lots and lots of different circumstances. There will be areas where they are outsourcing, so they are paying someone to fulfill their function. So in Britain, the collection of rubbish, I think in most areas now, is outsourced. So they create an ownership right, and you'll see this is now standard 32 in IPSAS concessions, and then they give away, or they outsource, or they pay someone, in fact, don't give away, they pay someone to fulfill their obligation, this idea of outsourcing. The second thing which comes from standard number 32 with that is a situation where you give rights of operation. So we have a road, the repair of the road is taken over by a private company, but to compensate them from that, they're allowed to charge tolls for using that road. The government takes a chunk of money for that. So they take, let's assume they split the revenues 50-50, but the private company has to operate the tolls and has to repair the roads. That would be an example. Right, we are creating assets and we are creating ownership rights, therefore. The government creates an asset, which is the ability to operate tolls on this road, and then it gives that asset, that asset is transferred to a private company in return for sums of money. So the government, therefore, we are saying, first of all, will have much more complicated ownership rights than a simple the right to buy. Secondly, when these things finally exist, there's much more they can do with them. They have much more opportunity to create ownership rights and create assets. So we get this idea of ownership rights. Whew. And finally, GFSM. Right, GFSM is your government statistics. Every government in the world, I believe every government in the world, has to provide statistics to the IMF, and those statistics are in a certain format, and they relate to GDP, number of employees, blah, 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 blah. And there's a whole load of statistics, and if you go onto the IFM website, you can call them up. You can certainly buy them anyway. Right, you must remember these things, because your computer system must be able to generate these things. If you can't generate them, you're going to have one very, very unhappy Minister of Finance if you can't provide the information in the format that is required by the IMF. And I think there are certain countries where they don't bother to calculate them. Places like Afghanistan, I think, don't bother to submit returns. But other than that, every country in the world, so from America through to the Nepal and so on, are providing these things. You must make sure that your government financial statistics, GFSM is Government Financial Statistics Manual. Your government financial statistics manual must be completed in time, in the right format, and it must contain information which is comparable to everyone else. Please, please, please never forget that. It's something when you go into IPSAS implementation teams that lots of guys who know a lot about IPSAS come in and they forget this. If you don't get it right and you forget about it, you have to completely rework your Oracle system, completely redo all the account mapping to this, so you've got to get it correct. When you go to Oracle, or I guess SAP as well, I've worked mainly with Oracle, you will find that they know what this thing is and that they will prompt you to buy it. Please make sure that your Minister of Finance, when he's completing his order form for his Oracle system, ticks that box, so the new system provides the statistics that the old system didn't. I don't actually know what happens if you don't provide them. If anyone ever finds out, let me know. Can I just say I very, very strongly do not recommend that. Okay, you've had 2 slides with, I forget, but something like 10 differences between the public and private enterprises. You need to have a checklist to understand what all of these things are and where you are. And we come back again to this idea again of using your local staff and getting real value from good quality local staff. And they will be able to guide you through these things during the implementation. You must take account of these things as you're going along, though. If you don't, you end up kind of cutting and pasting a chart of accounts from. Well, I've actually seen this in one country. They cut and pasted a chart of accounts from supermarkets that were operating in Russia. Now, what on earth the point of that was? It was for a centre bank as well. Now, what on earth the point of that was, and what conceivable value it was supposed to add to this day, I have no idea. But don't be that guy. Make sure you know what all the stuff is and you're doing a good job. You produce your chart of accounts, then you send it out to the individual ministries. The ministries will come back with 1,001 changes that they want to see on the chart of accounts. Be relatively strict with them and try and keep them. I tend to find that in governments you'll find that the Ministry of Agriculture and the Ministry of Finance will kind of agree with each other that we can get away with this and we can do this. When you go to more Western, more sophisticated organizations, the Ministry of Education and the Ministry of Health cannot agree between them on anything common at all because we are just so different. And international organizations, the UN and so on, two agencies that are basically doing fundamentally the same thing. No. Massively different is the story you get back. So put your hard hat on, strengthen your neck and push it through. Okay, let's move on to slide number 3. So my secretary has just come through and reminded me that part number 2 of this, our lecture number 2, was all about things which should be included in IPSAS and decisions to be made at early stage of feasibility studies. So thank you for that. Sadly, she hasn't brought me coffee, so I'm still doing this without coffee, under suitable stress. Right, slide number 3, therefore, is just a little thing. You can see the title there, Other Issues, Culture Change. These are just little things that we want to bring in, and they've kind of been mentioned already, so I'm just going to remind you of them again, because the politics and the idea as well that people are frightened by IPSAS is something that happens to you wherever you go. I remember going into one country, and as I said, I think I told you already that they took me to a room and they said, well, this is where the IPSAS machinery is going to be, because the people there had no idea what this was, and they thought that there were special machines that came with this. And then we decided that we would have a communication strategy. So we were in the capital, so we highlighted 10 different ministries, and 1 week we did 10 one-hour lectures and question and answer sessions. And so we went to, I think it was the Ministry of Education in the morning, and it was the first day, so we were doing 1 in the morning, 1 in the afternoon for 5 days. And it was just to talk to people, to allay their fears and say, look, we're here, here's my email address, you can contact us. And it was in a Russian-speaking country, so we can speak the language and we understand something about the culture as well. And we went to this ministry, and they were in a room, and they said, oh yes, there are not many people who come because it's IPSAS for the finance department, and the room holds 80 people or something. And we got there, and it wasn't actually possible to get into the room. They took us down a side room, and we came out the back. But there was like 250 people from this ministry trying to get into this room. And it was simply because everyone had heard about this. Everything was going to change. Everything was going to be new. People were worried they were going to get fired. They were going to worry they didn't know how to do their jobs. And, performance was going to drop. And of course, we had just no idea that this is what was going to happen. So, culture change. Be really, really careful with this stuff. We've got 3 little ideas of things that are going to change here. I think let's do the other ones. Materiality and substantive reform. Most governments, because of the pressure on them to be transparent, to be non-corrupt and so on, however well they're getting on with that one, they don't have any real concept of materiality. I've talked to you already about the fact that we were in one country, in their schools they had a disposal process for assets, and it applied to everything. So we found that they had thousands and thousands of dollars of crayons in the balance sheet. Simply because the crayons were gone. I mean, the kids had used them, they'd broken them, eaten them, whatever kids do with crayons. But the damn things were still there in the balance sheet, and we had to dispose of them. And of course, when the auditors comment, disposal forms, who was it disposed to? Where's the evidence that the things have gone? Well, there isn't any evidence. They're crayons, let's use a bit of common sense here. But the concept of materiality. So you're trying to introduce the concept of materiality. Even for your assets, we'll come on to this later, but looking at UN Women, we had a threshold of $1,000. Anything which, even though it was an asset that cost less than $1,000, was just expensed. Because why not what information does it give users, and what way does it distort your accounts? Yeah, okay, so we can keep details of, because when we first started introducing recording of assets to people, we found that there were offices and they were recording mice, you know, the mouse for your computer. These things are $8 or something when you buy 500 of them at a time. So, you know, this idea of materiality, how does it fit with people's mentality? And is a lady who's been an accountant for 25 years going to be happy knowing that now she has assets in her balance sheet, so she's supposed to put her assets there? This is an asset, but because it costs $10, it doesn't go to assets. So you're asking people, and it's not an intellectual question. She will be smart enough to get the point of the questions, but it's whether she has, I want to use the word guts, whether she has the mental strength to make that decision and then stand in front of an auditor and go, well, actually, I haven't stolen that mouse. You know, it's not for sale in the market today. It's over there. I took a decision based on the materiality of what's in my accounts. So you've got this idea of materiality. The second one is substance over form. In countries where their legal system is based on proof, so you have to have proof of everything. Therefore, substance over form is a difficult one. Look at the situation where you have a country and the country has a ministry of property. So property purchases are all done through one ministry. So there's a building, and the building is in the middle of a town, and the building is used by the Ministry of Education. But the owner of that building is the Ministry of Property. Now, in whose balance sheet does it go? We're going to come back to this when we do assets in more depth. But without giving you any further information, I would be expecting to hear from you that, well, it's probable that the Ministry of Education controls it, they use it, they're responsible for the repairs, that there's some kind of long-term lease on it, so it's going to appear in their balance sheet. Under your historic situation, it will appear in the balance sheet of the Ministry of Property, because the Ministry of Property actually owns it. Getting the Ministry of Property to relinquish that building, getting the Ministry of Property to accept and understand why they're relinquishing is a very, very hard job indeed. And the probability is that at certain points in time, particularly when there are assets that they want to hang on to, like buildings, because in their mind it will be, if we give all of our buildings away, why do we even exist? What happens to my job? Am I going to get fired? When people start going down decision routes like that, they're going to resist very, very hard. You're going to have to make compromises, and you're going to have to talk to people and be ready to discover what the situation is. Allay their fears or take it on the chin and accept that there's no material misstatement in your accounts by this. Okay, those are your two accounting principles, and it's hard to even call them accounting principles because they're not in the conceptual framework anymore. The third area where you really do have to get someone else to bite the bullet and someone else to come into the process and buy into that process is where you have the supreme audit bodies. Right, the supreme audit bodies is the state auditors. You will often find that the state auditors are not part of the Ministry of Finance. So as your implementation project is, your direct reporting line will be to the Minister of Finance, and so you'll be working therefore with the Treasury, with the purchasing group, with the accounting group, but the auditors are kept separately. And the logic of that would be either historic or more likely for independence purposes. You therefore have to spend some of your time and some of the Minister of Finance budget going out of the Ministry of Finance building and around the corner and talking to the auditors. What to expect from the auditors will depend country to country. In some countries you go to, they're incredibly forward looking, they're looking to do IPSAS certificates, and they want to do some training, they want to understand IPSAS, they demand to be involved at every step, and they buy into the process. In other countries, they are, we needed a document on Monday, and we're going to need a document on Tuesday. Nothing changes for us. Accruals are fine, but give us the proof of where the accrual comes from. But how do you give proof of where an accrual comes from? The easiest thing to do, therefore, is not to accrue, as long as there's no material misstatement. But the audit body needs to work alongside with you, and that audit body needs to be changing its mentality, its training, and also its procedures so that it understands. And in my experience, the audit body can often be much, much more difficult to deal with than your common or garden ministries. You need to ensure that they're part of the process. What you really cannot have is to go through implementation, to do a beautiful set of IPSAS, to have the Minister of Finance absolutely overjoyed, everyone's got all this new knowledge and all this new enthusiasm, and then the auditors to come along and stamp rejected all the way over it. Because then, you know, it's who peed on your parade. So, work with your audit bodies, make sure that they're included from the very start in all of the committees, that you listen to their points of view. If you get some good guys from the auditors as well, they'll give you some good information on things to look for at your implementation program. And make sure that those guys are bought into this whole process. Okay, I'm sure there's others. There's a million and one things that you're going to come across with culture, and you're going to come across religion and stuff like that. One country I worked in, we had to have sing-songs in the morning and so on, which I have to say I actually quite enjoyed. Right, these are all things which are going to come leaping out at you when you undertake your implementation. Materiality and substance over form are difficult to deal with, and in my experience they happen everywhere. Supreme audit bodies are a cross-section of the population in the same way that Ministers of Finance are and Ministers of Education are as well. So you get some good ones and you get some not so good ones. Best of luck with that one.